Big news in the past hour or so. The Fed announcing it's raising the discount rate for the first time in 3 years. A move that was telegraphed by the Fed chairman, raising it to three quarters of a percent from 0.5%. And right now I'm joined by Dr. Larry Meyer. He's a former Fed governor, one of the country's most respected economic minds. He's also the co-founder of Macroeconomic Advisors, to talk about this breaking news and also regulatory reform and what the role will be for the Fed. Thank you for joining us.
Oh, my pleasure.
This discount rate move was telegraphed, and you saw it coming as well.
Oh, well before it was telegraphed by the chairman. And it's important to understand why it was done. The spread was narrowed as part of the emergency liquidity infusion by the Fed. It wasn't part of monetary policy. It was part of the liquidity facility. And they've already terminated most of the liquidity facilities on February 1. And since this is part of that, they needed to do as soon as possible after February 1.
Is this, in fact, normalization of policy, as the Fed has suggested, or is it something more? Because there's some investors out there seeing this and taking this as a cue as a first shot across the bow.
Well, then they don't understand the chairman, or they think the chairman is lying. The way to look at this is not part of the exit towards an increase in the funds rate. This is the end of the termination of the emergency liquidity facilities. Although only the beginning of the normalization of the discount rate. It says absolutely nothing about the timing of the first increase in the funds rate.
And remind us your own sense about when the funds rate will start to increase, or how the Fed, again, tries to tackle this exit strategy going forward.
All right. So first of all, it obviously depends on your forecast, but we believe that the Fed will not raise the funds rate for the first time until the middle of 2011. And the chairman has already told us pretty much all we need to know about exit strategy, that they'll begin to reduce reserves before they raise the funds rate, probably not far in advance. So the markets will correctly anticipate that a rate increase is around the corner, and they may or may not sell MBS from their portfolio. But if they do, it will come well after the increase in rates and be done very gradually and extremely well communicated to the markets.
There was some discussion in the minutes, as we saw, that some members of the board, some members of the FOMC talked about selling those MBS securities. There's been a lot of debate about that, what the impact will be, what will happen, of course, to long-term rates, to mortgage rates there. What's your sense about the debate? Is there dissension among the ranks? Is that what you interpreted at all in those minutes? No,
there's always a range of opinions, and there certainly is in this respect. You have to appreciate that the hawks on the committee never liked the purchase of MBS because they thought it was credit allocation. The Fed should only be involved in Treasury purchases. Second, that the hawks tend to put more emphasis on reserves than the rest of the committee, and therefore they want to reduce reserves sooner rather than later to reduce their sense of inflation risk. That's not the view of the rest of the committee. You reduce reserves to make interest on reserves work better, and you don't have to do it until soon before the increase in rates, and that's what they're going to do.
All right, let me ask you in our time remaining about regulatory reform and this overhaul that's still being debated on Capitol Hill, the appropriate role for the Fed. Could you tolerate the Fed losing some of its authority under some of the proposals that have been outlined? As you heard Chairman Barney Frank, the House Financial Services Committee, in terms of consumer protection, his argument basically the Fed was asleep at the switch.
I'd say two things about that. Consumer protection is not a core responsibility. I believe no other central bank has that responsibility. I think the Fed should never be given that responsibility. Having said that, they could do it better than anybody else, because nobody else can balance the interests of consumers and the financial industry like the Fed can and has done.
Are you worried at all about the Fed, again, losing authority even in other areas as a result of these changes under consideration?
Absolutely. So I would say two things. The most important thing is retaining their supervisory authority as a consolidated supervision over all bank holding companies, indeed all systemically important financial institutions, systemically important bank holding companies. Now, as my understanding, that's a story in the House bill. I don't think that is the story in the Senate bill.
They're talking about Treasury chairing this council.
Oh, no. You have to. There are two things. One is the actual supervision,
the single bank rate,
and the second is who is in charge of this macroprudential supervision, identifying across markets, across institutions, where the risks are emerging. So the first is by far the most important. And if the Fed is removed of that authority, then basically Congress has taken responsibility for financial stability. They're on the hook. And the chances of a financial crisis have increased dramatically. A central bank always needs hands-on authority for supervision of systemically important financial institutions.
Right.
Can we talk about the Risk Council?
We're going to have to leave it there. I'm sorry to say, Dr. Larry Meyer, joining us here in Washington.